Bankrupt. Banks face $390 billion loss if silver reaches $100. They are panicking. On January 15th, 2026, something happened that has not occurred in 30 years. Central banks around the world made a choice. They chose gold over the US dollar. For the first time since 1995, these banks now hold more gold in their reserves than American debt. This is not a prediction. This is not speculation. This has already happened. And the biggest banks in the world, Bank of America, JP Morgan, HSBC, they are sitting on a position that could wipe them out completely. $390 billion in potential losses. If silver reaches just $100 per ounce, some of these banks will not survive. And they know it. What they did next exposed everything. Welcome to hidden currency. Now, before this story continues, a small request. The way a person saves an important newspaper clipping, the way someone bookmarks a valuable page in a book, that small red subscribe button, it works the same way. One click. And these economic warnings, they reach you directly. No searching, no missing out. If this information matters, then that button matters too. Also, drop a comment below. Which city? Which country? Where are you watching this from today? Now, let us continue. On Thursday, January 15th, 2026, a quiet revolution occurred in the global financial system. No headlines announced it. No breaking news alerts interrupted regular programming. Yet on that day, central banks around the world crossed a line that had not been crossed in 3 decades. For the first time since the mid-1990s, these institutions now hold more gold in their reserves than U.S. Treasury debt. This single data point tells a story that every businessman, every entrepreneur, and every serious investor must understand. The story begins in 1971. That year, the United States abandoned the gold standard. President Nixon closed the gold window. From that moment forward, the US dollar became a pure fiat currency. It was backed by nothing but faith. Faith in the American government. Faith in the American economy. Faith in American institutions. For 50 years, that faith held. Countries around the world accumulated dollars, and they bought US Treasury bonds. They held American debt as their primary reserve asset. Why? Because they needed dollars to buy oil. They needed dollars to conduct international trade. They needed dollars because the entire global system was built on dollar dominance. But faith is a fragile thing. It can erode slowly, then collapse suddenly. The erosion began years ago. Central bankers watched as the U.S. government increased its spending. They watched the Federal Reserve print trillions of dollars. They watched the national debt climb from 10 trillion to 20 trillion, then to 30 trillion. Now it exceeds $36 trillion. Each new trillion diluted the value of the dollars they held. Each new round of money printing raised the same question in their minds. How long can this continue? And what happens when it stops? So they began to diversify, quietly, slowly. China increased its gold purchases. Russia accelerated its gold accumulation. India, Turkey, Poland, Saudi Arabia, all of them began converting paper dollars into physical gold. The trend was clear to those who were paying attention. But January 15th, 2026 marked the tipping point. On that day, the accumulated gold holdings of central banks finally exceeded their holdings of U.S. Treasury debt. This is not a technical detail. This is a vote of no confidence. This is the global financial establishment saying, in the clearest possible terms, that they no longer trust American paper. They want something real. Gold cannot be printed. Gold cannot be inflated away. Gold is not controlled by any single government. Gold cannot be frozen by sanctions. And that last point matters enormously. When Russia invaded Ukraine, the United States froze Russian dollar reserves. Hundreds of billions of dollars. Locked, inaccessible, weaponized. Central bankers around the world watched this happen. And they asked themselves a dangerous question. If America can freeze Russia's dollars, can they freeze ours too? The answer, they realized, was yes. Any country that displeases the United States, any nation that falls on the wrong side of American foreign policy, their dollar reserves could be frozen overnight. This realization changed everything. Gold cannot be frozen. Gold cannot be sanctioned. Gold sitting in a vault in Beijing or Moscow or Riyadh, it belongs to whoever holds it. No American president can touch it. No Federal Reserve chairman can devalue it. No Treasury secretary can weaponize it. This is why central banks are buying gold. This is why they are selling U.S. Treasury bonds. This is why January 15th, 2026 matters. The U.S. dollar has not collapsed. Not yet. But its monopoly as the global reserve currency, that monopoly is ending. The world is diversifying away from American debt. And when central banks move, private investors follow, corporations follow, wealthy individuals follow. The smart money is already repositioning. The question for everyone watching this is whether they will reposition too, or whether they will be caught holding paper when the music stops. There's a game that bankers have played for decades, a game most people do not even know exists. It works like this. A bank sells something it does not own, it collects the money today, and it promises to deliver the product later. The bet is simple. The price will fall. When it does, the bank buys the product cheaper, delivers it to the buyer, and keeps the difference as profit. This game has a name. It is called short selling. And for 30 years, the biggest banks in the world have played this game with silver. Bank of America, JP Morgan, HSBC, Citigroup. These institutions have sold silver they never owned. They have collected billions of dollars, and they have promised to deliver metal that does not exist. For 3 decades, this game worked perfectly. Every time silver prices rose, the banks would flood the market with paper contracts. Millions of ounces sold in minutes. The price would crash. Panic would spread. Investors would sell their positions, and the banks would buy back their contracts. At lower prices, profit, again and again, year after year. The game seemed unbeatable, but every game has a weakness. And the weakness of short selling is that losses are unlimited. When someone buys silver at $50, the maximum loss is $50. The price can only fall to 0, but when someone sells silver short at $50, there is no maximum loss. The price can rise to 100, to 200, to 500, to 1,000. There is no ceiling, and right now, the banks are staring at that ceiling, watching it disappear into darkness. The numbers are devastating. According to the latest exchange data, commercial banks hold short positions totaling approximately 4.4 billion ounces of silver. 4.4 billion. To understand this number, consider that the entire annual global silver production is roughly 800 million ounces. The banks have sold short more than 5 years of global mining output. Metal that has not been dug from the ground. Metal that does not exist. Metal that they have already collected payment for. Now, do the mathematics. At $90 per ounce, 4.4 billion ounces equals $396 billion in exposure. Round it down, call it $390 billion. This is the number that keeps bank executives awake at night. This is the number that triggers emergency board meetings. This is the number that explains everything that happened on January 15th. For context, Bank of America has a total market value of approximately $250 billion. Citigroup is worth roughly $120 billion. If silver reaches $100 per ounce and stays there, the losses on these short positions would exceed the entire market capitalization of these banks. They would be technically insolvent. They would require government intervention. They would need bailouts. Again, the executives understand this, the risk managers understand this, the board members understand this, and they are terrified. On the night of January 15th, while Western markets slept, something unusual happened. Silver had closed the American trading session at $92, a historic high. Momentum was building. Retail investors were buying. Industrial demand was surging. The squeeze appeared imminent. Then, between midnight and dawn, in the thin liquidity of Asian and European trading hours, the price collapsed. $5. In a matter of hours, 92 became 87. When American investors woke up, they saw red on their screens. They saw a 5% drop. They saw what looked like a reversal. And some of them panicked. They sold, exactly as intended. This was not a natural market correction. This was not profit-taking by long-term holders. This was a survival operation. The banks dumped massive quantities of paper contracts. They triggered stop-loss orders. They forced margin calls on leveraged traders. They created fear. They manufactured panic. They bought themselves time. But here is what they did not do. They did not solve the problem. They did not reduce their short positions. They did not find physical metal to deliver. They simply delayed the inevitable. The fundamentals remain unchanged. The physical shortage is real. The industrial demand continues growing. The vaults continue emptying. And the price will come back. When it does, when silver breaks through 95 and approaches 100, the banks will face a choice: cover their positions at catastrophic losses, or double down on manipulation and risk total system failure. In part 3, the evidence becomes undeniable. Shanghai cuts position limits, lease rates explode to 20%, and the paper market begins to separate from physical reality. There is an old saying among commodity traders: paper burns, metal does not. For years, this saying was treated as a joke, a relic from a simpler time, a nostalgic phrase used by old men who remembered when markets were honest. Today, that saying is becoming prophecy. The paper-silver market and the physical silver market have begun to separate like two trains on parallel tracks, moving in opposite directions. One is fiction, the other is reality, and reality always wins. Consider what happened in Shanghai. The Shanghai Futures Exchange is not a small operation. It is the largest physical silver exchange on the planet. When London and New York trade paper promises, Shanghai trades actual metal, real silver, bars that can be touched, weighed, verified, delivered. On January 15th, 2026, this exchange made an announcement, a quiet announcement, buried in regulatory filings, ignored by mainstream financial media, but noticed by those who understand what it means. Shanghai slashed its maximum position limits from 7,000 lots down to 3,000 lots, a 57% reduction, effective January 19th. Why would an exchange do this? Why would the largest physical silver market in the world suddenly restrict how much silver traders can hold? The answer is uncomfortable. They are running out of metal. Delivery requests have been piling up. Traders are not rolling over their contracts anymore. They are demanding physical silver. They want the bars. They want the metal in their hands, and Shanghai cannot provide it. So they changed the rules. They reduced the maximum bet size. They forced traders to sell positions they wanted to keep. This is not normal market behavior. This is crisis management. This is an exchange saying, without actually saying, we cannot handle what is coming. But Shanghai is only part of the story. The lease rates tell the rest. For those unfamiliar with this term, a lease rate is the cost of borrowing physical metal. When a manufacturer needs silver for solar panels, when a tech company needs silver for electronics, when a short seller needs silver to cover a position, they borrow it and they pay a fee. That fee is the lease rate. In normal times, when silver is abundant, this rate is negligible, 0.5%, maybe 1% annually. Borrowing silver costs almost nothing because there is plenty available. These are not normal times. Current lease rates have exploded 5%, 10%, 15%. Some private transactions report rates as high as 20% per year, just to borrow silver for a few months. This is desperation. This is the market screaming a message that the paper price refuses to acknowledge. There is no metal. The vaults are emptying. The silver that should be sitting in depositories, waiting for delivery, is gone. Where did it go? Into solar panels, into electric vehicles, into smartphones and medical devices, into military applications that governments do not discuss publicly. Silver is not just a precious metal, it is an industrial necessity. And industrial demand does not care about paper prices. A solar panel manufacturer cannot install paper contracts on a rooftop. An electronics company cannot solder paper promises onto a circuit board. They need real metal, and they are paying whatever it takes to get it. This creates a phenomenon called backwardation. In a normal market, future prices are higher than current prices. This reflects storage costs. This reflects the time value of money. This is how commodity markets are supposed to work. But silver is now in backwardation. The spot price, the price for immediate delivery, is higher than future prices. This means buyers want metal now, not in 3 months, not in 6 months, now. They do not trust that metal will be available later. They do not trust that contracts will be honored. They do not trust the system. And when trust disappears from a market, that market is approaching failure. The paper price says $87. The physical market says, we will pay whatever you want. Just give us the metal. This disconnect cannot last. Either the paper price rises to meet physical reality, or the paper market collapses entirely. There is no third option. The banks are betting everything on their ability to keep the illusion alive, to keep the paper price suppressed, to keep investors believing that $87 is real. But Shanghai knows the truth. The lease rates know the truth. The empty vaults know the truth. And soon, everyone else will know it too. In part 4, the endgame arrives. What happens when contracts cannot be honored? What happens when force majeure is declared? And what the smart money is doing right now, every financial crisis in history, has followed the same pattern. First, the insiders see it coming. They reposition quietly. They move assets. They prepare. Second, the warning signs become visible to those who know where to look. Data points emerge. Patterns form. The informed begin to act. Third, the public notices something is wrong. But by then, it is already too late. The exits are crowded. The lifeboats are full. And those who waited go down with the ship right now. The silver market is somewhere between stage 2 and stage 3. The insiders have already moved. Consider Rick Rule, a name that carries weight in precious metals. Decades of experience, billions in managed assets. A reputation built on being right when others were wrong. Last week, a rumor spread across the internet. Rick Rule sold his silver. Panic followed. If Rick Rule is selling, should everyone sell? But the rumor was incomplete. The truth tells a different story. Rick Rule sold 80% of his physical silver. He took profits. He recovered his original investment. He set aside money for taxes. And then he did something interesting. He bought more silver mining stocks. He increased his exposure to silver producers. He moved from physical metal to leveraged plays on the same metal. This is not bearish behavior. This is strategic repositioning. He still believes silver is going higher. He simply wants more leverage on the move. When silver doubles, mining stocks can triple or quadruple or more. Rick Rule is not exiting silver. He is concentrating his bet. The smart money understands what is coming. They understand the mathematics. They understand the physics. They understand that when 4.4 billion ounces of short positions meet a market with no physical metal, something must break. The question is not if. The question is how. There are two possible outcomes. The first outcome is an orderly repricing. The banks slowly cover their short positions. The price rises steadily. $100, $150, $200. Investors who hold physical silver make substantial profits. The system absorbs the shock. Life continues. This is the optimistic scenario. The second outcome is force majeure. Force majeure is a legal term. It means an extraordinary event, an unforeseeable circumstance, something beyond anyone's control. When an exchange declares force majeure, it means contracts will not be honored. Delivery will not happen. Positions will be settled in cash. At a price the exchange determines. Imagine holding a contract for silver at $87. Imagine the physical price exploding to $200. Imagine the exchange declaring force majeure. Imagine receiving a cash settlement at $90 while the real metal trades at $200. This is not theoretical. This has happened before. In 1980, when the Hunt brothers cornered the silver market, the exchanges changed the rules mid-game. They restricted buying. They forced liquidation. They protected the banks at the expense of everyone else. History does not repeat, but it echoes. The same institutions that changed the rules in 1980 are facing the same pressures today, and they have the same tools available. This is why physical metal matters. A silver bar in a private vault cannot be force majeured, cannot be cash settled, cannot be defaulted upon. It simply exists. It holds value. It waits. The firms that analyze these markets have begun publishing forecasts that sound impossible. One major asset management company, using models developed decades ago, now projects gold at $184,000 per ounce, not $4,000, not $10,000, $184,000. If this sounds insane, consider the mathematics. The global money supply has exploded. The gold available to back that money supply has remained relatively constant. Divide one by the other. The numbers become very large. If gold reaches such levels, where does silver go? At a historical ratio of 15 to 1, silver would exceed $10,000 per ounce. Even at a conservative ratio of 60 to 1, silver would reach $3,000 from $87 today. These are not predictions. These are mathematical possibilities. The range of outcomes has widened dramatically, and those who hold physical metal are positioned for all of them. The message from hidden currency is simple. Understand what is happening. Recognize the signs. Position accordingly. The central banks have made their choice. Gold over dollars. The Shanghai Exchange has made its choice. Restrict trading before the system breaks. The lease rates have delivered their verdict. Physical metal is vanishing. The only question remaining is what choice each individual will make. Hold paper promises, or hold physical reality. The window is closing. The end game has already begun. This is Hidden Currency. Thank you for watching until the end. If this information brought value, share it with someone who needs to hear it. Subscribe for more economic analysis. And remember, in times of monetary crisis, what is hidden eventually becomes visible. Until next time, stay informed, stay prepared.